Hi, I really hope you enjoy this educational video. My name is Mark Byelich. I'm a certified financial planner, and my team and I focus on developing tax-efficient or tax-free retirement strategies for our clients. We also focus on investment strategies that allow folks to eliminate the worry and have the potential growth that you need in retirement. So enjoy the video, and at the end, I'll tell you how you can schedule a no-cost, no-obligation consultation with me. Enjoy. The main topic this week, a lot of the topic this week is going to come from the Ed Slott Group. As you know, I spent a couple of days, I guess 2 weeks ago now, in my semi-annual training class, and as always, I've come away with a lot of information that I want to share with you. I think it's timely, topical, and always important when it comes to retirement planning. So it's 10 a.m. Let's get started. As always, we're going to go over some of the information that we get from the Slott mailbag and questions that come in, and then we're going to talk about the markets and some analyst reports, and then we're going to have a financial planning topic. And our topic today comes from the training class I had that I just spoke about, and this is about executor responsibility. So there are two things that I'm really passionate about in our practice. And one is, as you all know, tax efficiency. So, I think that we do a really great job with our investments, and so do many, many other people. There were very few investment firms out there. I'm not talking about the mutual funds or the money managers. Most of those don't do a great job, but the people who do what I do, most of them tend to do a very, very good job. And I would hold what we do up against anybody from an investment management point of view. Again, I think what we do is superior with the account segmentation from a cash flow and planning point of view. But my passion lies in tax efficient planning, and we've seen that make a tremendous difference in the lives of the individual and their heirs. But the second is this notion, or this idea of executor, trustee, and power of attorney responsibility. Hardly anyone talks about this, and it's such a big topic, or it's such a big, important topic, and you're going to see an example of that today. But just like people are getting on the train of, okay, I understand now that taxes are potentially going to be a significant risk in the future, and I could be paying double what I'm paying now, and it could absolutely have this devastating effect on my retirement plan. People are also, and 10 years ago, that was a tough sell. People were pushing back all the time. It was often difficult to get someone to consider Roth conversions, working against their CPAs. It's so much easier today. Everybody kind of gets it. They see, we're almost there. That's why they see it coming. And this idea of executor, power of attorney, and trustee responsibility, I hope also gets there, because it's so important. Most people don't pay attention to it. I do a couple of these a year, maybe at the most 3 a year, where I'm brought in and engaged to help somebody map out and keep up with their fiduciary responsibility as an executor, power of attorney, or trustee. I've had attorneys hire me for this. I've taught attorneys about this. So it is just so vitally important. So we're going to talk a little bit about that today, and I called it executor responsibility. Now, this isn't about what an executor has to do in his or her duties. This is about one key area, and I think you're going to find it interesting. So let's start with our Slott report. So this one is from Ian. He likes to be called Ian, and you'll meet Ian at some point. We'll have him on for a special webinar, but he's an attorney. He's one of Ed's analysts, and they all do a great job. And he's referring to spousal rollovers in this article. So he writes, as discussed in the October 18th Slott report, spousal beneficiaries can take advantage of certain payout rules that aren't available to non-spouse beneficiaries. So we know that with the Secure Act, we lost stretch IRAs for mostly everybody, unless you're a designated beneficiary or that's not the term. It is a eligible designated beneficiary, and that includes spouses. So spouses have an advantage of and a lot more flexibility than anybody when it comes to inheriting an IRA. So in this case, Ian writes, for example, a surviving spouse who remains a beneficiary can defer minimum distributions, RMDs, until the year using a woman as an example of the inheriting spouse, until the year her deceased spouse would have turned age 72. Also, when RMDs begin for surviving spouse beneficiaries, the spouse can go back to the IRS single life expectancy table each year to recalculate her expectancy factor. And that's helpful because the way we have to calculate it for inherited IRAs is different than using your own life expectancy. Instead of removing a beneficiary, a surviving spouse can roll over inherited funds to her own IRA, a spousal rollover, it's called. A spousal rollover can be done at any time. It often makes sense for a surviving spouse to remain a beneficiary until she turns 59 and a half and then do a spousal rollover. This allows the spouse to tap into the IRA funds without worrying about the 10% early distribution penalty. I think I talked about this last week, and I used the example. I'm 53 years old. If God forbid I passed away, my wife would inherit my IRA, my 401k, and she could keep that as an inherited IRA rather than doing a spousal rollover in her own name. The benefit of my wife doing this, because she's also under 59 and a half, is that if she needed access to those funds, if she wanted to pull money out of the IRA or out of the 401k, and if she kept it as an inherited IRA, then she would pay tax on those distributions, of course, but she would not be subject to the 10% penalty. Once she treats it as a spousal rollover, then she's subject to the 10% penalty if she's under 59 and a half. But what she can do is once she crosses over that 59 and a half threshold, she can just turn into a spousal rollover. So there's a lot of flexibility there. Doing a spousal rollover allows the spouse to be treated as the owner of the rollover fund. This permits the spouse to defer required minimum distributions in the rollover dollars until she reaches her own required beginning date. Now, in this case, my wife is a year older than me, so it's really close. But if you had a spouse who was significantly older than you, you might want to then roll that into a spousal rollover. Then you won't have to take required minimum distributions to whatever the required beginning date is at the time, currently 72 years old. Let's see. Then he talks a bit about it's a spousal rollover is treated retroactively going back to January 1st and the year it's done. That gives some flexibility again about RMDs. If you find yourself having to do an RMD at the end of the year and you do a spousal rollover and you don't want to, if you do a spousal rollover, it kind of resets the clock to January 1st. So that's about spousal rollovers. We talk about that a lot because it's so important. Because here's the thing. People generally aren't thinking clearly when they're inheriting their spouse's funds. And they can get talked into things by folks who just want to facilitate and act quickly in getting assets transferred, because the way that most advisors get compensated is to open accounts and have a fee running on that. So whether it's Vanguard, Fidelity, or whomever, they all get compensated on accounts. So I always say pause, don't do anything until you have a chance to evaluate everything. So this is why it's important to discuss this from time to time. Here's a really good question that came in. So this is their mailbag, the Slott Report mailbag. And these questions are answered by Sarah Brenner. Sarah's also an attorney with Ed's Analyst Group, and she does a great job. I think I've told you that Sarah is one of my go-to folks there. We talk often. I have 4 IRAs. The question comes in from a fellow named Glenn. I have 4 IRAs. The once per year rollover rule mean I can only take one distribution per year in total, or does it mean I can take one distribution per year from each of the 4 IRAs? So the once a year rollover rule came about several years ago. It was a court decision in tax court, and the IRS or the tax court said, if you take a 60-day rollover anytime within a 1-year period, then you can't do another one without it being a full distribution. It was really common for people to do multiple 60-day rollovers. So they would take the money out and put it back in within 60 days, and it wasn't considered a taxable event. You've got to be really careful here, because the answer to Glenn's question is the once per year rollover rule can be confusing. The IRS made it clear in guidance that this rule does apply in the aggregate. It means you can't take one from each of the 4 IRAs. You can only take one. It does not apply on a per IRA basis. This means that no matter how many IRAs you have, you cannot roll over any IRA distribution that occurs within 12 months of another distribution that was rolled over. Why is that important? Well, again, people get caught in traps. And if you think about how this might work, let's just say you have an IRA with $1 million in it, and you have an IRA with $10,000 in it, and you want to consolidate. Many people come to us, like, I have things all over. I want to consolidate, make things easier. God forbid I pass away, then my spouse has one person to talk to, and it's easier for him or her. So if that's the case, and you have $1 million IRA, and you have a $10,000 IRA, and you do a 60-day rollover of the $10,000 IRA, and you get that done on, well, it's November 2nd. You get that all done on November 2nd, and then on November 3rd, you complete the $1 million 60-day rollover. Now, this is a 60-day rollover, not a direct transfer. What happens to that $1 million rollover? So you did a $10,000 60-day rollover on November 2nd. You did a $1 million rollover, 60-day rollover on November 3rd. Well, that $1 million rollover would be considered a complete distribution, cannot be undone, or at least you'd have to ask for an exception, which isn't likely, but cannot be undone, and they'll be fully taxable. So be careful. The easy way to do this is do a trustee to trustee transfer. When we receive IRA or 401k monies, they're always made out to the custodian for the benefit of the owner of the IRA. Therefore, you have no risk of this. So, but people try to get funny, or as I say, they try to get cute. Here's another question. This is about the proposals come out of Congress. So Michael writes, I have a question about the new proposals in Congress. Are inherited IRAs added to the total to see if a taxpayer is above $10 million? By definition, they are already in RMD phase. So I wonder if they are excluded from those forced RMDs of assets above 10 million. Remember, the proposed law that came out of the House Ways and Means Committee unanimously 100% supported. Oh, goodness. I don't know what just happened there, but 100% supported out of the House Ways and Means Committee was that any IRA above $10 million forces a required minimum distribution. And it's, I believe it's 50% of the amount over $10 million. So if it was $11 million, you'd have to have a distribution of $500,000. So Michael here is asking if that includes inherited IRAs. And Sarah writes, there have been a lot of questions about the recent proposals coming out of Congress that would restrict very large IRAs and require minimum distributions from them. The proposal is currently written would include inherited IRAs when determining whether a taxpayer exceeds the $10 million threshold. It's important to remember that right now these are only proposals. No one knows for sure whether they will become law, but we're keeping a close eye on them. So great info, Sarah. Let's see if we have any questions before we move on to the next section. I don't see anything. Okay. I hope these slot updates are helpful. Again, give me some feedback on this. This is something we added maybe 6 months ago, and I have heard from a few people that they really like this part of the webinar. So it's always good to hear, pros and cons. If there's something you don't like about it, tell me that too. That's okay. So let's talk about the markets. Positive markets in the last week, so ending October 29th. The Dow Jones was up 0.4%. The S&P 500 was up 1.35. The year-to-date on the S&P 500 as of Friday is 24%. The year-to-date as of the Dow Jones as of Friday is 18.77%. Really, really strong numbers. I hope it continues for the rest of the year. I don't think that we're going to see much fluctuation based on whatever happens with the elections today, because they're all local elections. But we do have, midterms coming around the corner. So I'm sure next year is not going to be a lot of fun with all the nonsense around elections. But overall, the international markets suffered last week. The lowest was down 2.18%, with a year down 0.15. And then we did have a little positive there. So there are the emerging markets I was just talking about, but the global U.S. market, or its global world, ex-U.S., so it doesn't include the U.S., was down slightly, 0.21% last week, but still up 13% for the year. Bonds, we talk a lot about bonds. I've told you about the risks of bonds, especially, uncertain interest rate markets as interest rates go up. So the most popular, I'd say, investment kind of sweet spot for bonds is this Barclays aggregate index that's used. So that was up slightly for the week, 0.52%, but down 1.58% for the year. So, this is, and some of the global bonds are down 7%. So this is always the risk of using bonds to offset the risk of stocks solely. That's why principal protection can be very, very helpful here. And there's a great report that came out from BlackRock last week that I'm trying to find a client approved piece that talked about something I've been talking about for years, and that if you're using principal protection, and this talked specifically about fixed index annuities, then it has to be a significant portion of your portfolio. I typically run it at a third, so that's 33%. BlackRock did an amazing study with 30% that showed obviously protection in down markets that was significant. A greater increase in medium markets, right? So when there's a bit of growth, but not a significant amount. But of course, it did affect the overall return. You didn't get as high a return in the booming markets, but most people aren't concerned about that. They're concerned about getting them, protecting what you have and still having some good level of growth. Very, very few people are swinging for the fences when we start working with them. All right, so they're the markets for the weeks. So the most interesting, and where I'm going to spend my time with the analysts this week, because it's a relatively long report, was BlackRock. So BlackRock occasionally does this manager views. Now I should have the information about just the breadth of BlackRock as a global investment manager and analytical team, but they're in many, many countries throughout the world. They don't all just sit in the offices in Princeton, New Jersey, and think about what's going on around the globe. They live and work in these areas where they're responsible for. So the portfolio managers, BlackRock writes, discussed which 2022 market drivers they see as most overrated and underrated. A majority sees capital spending boom and China's path toward greater state involvement as underrated. When asked to name the single most over or underrated driver, more than a third chose supply frictions for the former, and almost a quarter chose central bank policy for the latter. So more than a third chose supply frictions for the most overrated, and central bank policy for the most underrated. So let's talk about supply frictions. Supply frictions are overrated, they said. Says one fixed income portfolio manager who expects supply chain disruptions to dissipate, though he expects some stickiness in labor and energy. He sees wages continuing to escalate, but doesn't think this necessarily will be inflationary. I don't know if I agree with him, just from what we're seeing in the real world here. Not suggesting this person isn't in the real world, but what I hear from folks is, while I may be making more money or I appreciate some of the stimulus that came out, I'm having a hard time paying for things. I was talking to a niece and nephew of mine, and they're in exactly that situation. They said, they're trying to save money, but everything's more expensive. I filled up my Jeep yesterday at Costco, which is the cheapest gas around, probably, I think. And it was still over $60. And, that's a lot. And I don't drive that much, so I'm thankful for that. But, so ever since my wife got a Tesla, it seems kind of silly to even go to the gas station anymore. But so the persistent consumer demand and the capital spending boom are underrated market drivers. This one analyst says demand is extremely high and inventories are not especially low in aggregate. The relatively good earnings releases show firms have a decent supply of stock to sell. China dynamics, one writes, are also generally underrated. Markets underappreciate the extent the impact of this country has on global economies, and the shift towards greater state involvement makes for a tough investment dynamic. So there's a shift happening in China, as you probably know. It's shifting more to a state-controlled economy, and this person says that makes for a tough investment dynamic. Overrated central bank moves, so there doesn't. this person saying all this tapering we're talking about, and you hear discussed, and we talked about what that was maybe a month or so ago, that it's not going to have as much effect on the market as people are saying. Let's see. Most overrated are the reopening trade, which he also sees disappearing from the rearview mirror in the coming months alongside supply chain disruption. So this analyst says we're making a lot out of nothing. This supply chain issue and the reopening, everybody's talking about, what's going to happen when everybody gets actually reopened. That's going to be really a nothing thing. So again, we'll see. These people are often wrong. But it's interesting to hear their thoughts. Leverage credit has also some weakness. I'm not going to get into that. Persistent consumer demand is also underrated in this person's view. Capital spending is overhyped as a driver for 2022 and is more of a longer term issue, he says. So this is going into 2022. All this discussion about people have a lot of money to spend and the market's going to fly because of that. And he's saying that's overrated. He's saying that's underrated. Interesting. That's interesting. A strategist says the most underrated driver is central banks. We just talked about that. And that's really it for BlackRock. But I thought that was an interesting take on, just getting an idea of these kind of roundtable discussions among these managers, and really one of the biggest investment firms in the world, and some of the best investment analyses come out of here. Now, again, I don't always agree with BlackRock. I'll remind you that BlackRock was one of the first ones talking about inflation at the beginning of the summer last year. So they were ahead of that. But then, as I've mentioned before, they made a strong bet on the European Union recovering from COVID faster than the US, and that didn't work out well. But interesting to hear their thoughts. Okay, let's talk about financial planning. And I'm just gonna post this here. I'm going to share my screen. There's a question. Don Slicer. What about TIPS, inflation protected bonds? So they're bonds that are designed to increase with inflation. Don, I did some research about TIPS about a month or two ago, and there was some kind of issue that didn't make them attractive to me. But I don't recall exactly what the rub was. I think it was that there was a downward pressure that was affecting their ability to keep up with the type of inflation that we're likely experiencing. And therefore, that's why we started looking for higher yielding positions, like I've talked about before. And I'm even going to begin incorporating a covered call ETF that JP Morgan rolled out about 6 months ago to help drive some of that income. Great question, Nadine. All right, so let's share that screen. Now you should see in front of you a screen that says financial planning topic, executor responsibility. Just please raise your hand for me if that's what you're seeing. Okay, that's great. So thank you very much, everyone who raised their hand. So this is the Lee case. So you'll see here, I'm citing the case here so that you can look it up if you want to. This is the Lee case in the United States Tax Court. That's from July 20th of this year. It was settled, and we'll talk about why that's important. 20 years ago, this started. And this is the estate executor found personally liable for unpaid estate tax. And then again, this gives the site, estate of Quang Lee versus Commissioner, memo 2021-92, and when it was decided July 20th, 2021. So this is really fresh. There's another decision in which an estate executor becomes personally liable for unpaid estate taxes. In this case, the tax court found the executor liable because he made distributions of estate assets, knowing that the distribution would render the estate unable to satisfy its estate tax liability. This decision came almost 20 years after the executor was named executor of the estate. And you'll see the gap in time and just how you can kind of get complacent and you can't do it. And what really is interesting is that we learn about the professional training, experience, and position of this executor. So here's the timeline. September 2001, Quang Lee dies and Andrew Freeze, now this is all public, right? It's in tax courts. This is all public. Andrew Freeze, an attorney and a municipal court judge, is named executor of the estate. This is very common that attorneys handle estates, and this is a bad example of why they should, but this is why I often suggest that attorneys handle estates for people. Yes, there's a fee. Often it's expensive, but it can be worth it. May 2003, Mr. Freeze files a federal estate tax return. July 2003, Mr. Freeze makes distributions to estate beneficiaries totaling over $1 million, $1,045,000. It should really say begins to make distributions to the estate, and you'll see why. So that's July 2003. In April 2006, almost 3 years later, the IRS sends Mr. Freeze a notice of deficiency saying the estate owes over $1 million in taxes and about $450,000 in penalties. In July 2006, now a full 3 years later, Mr. Freeze appeals the IRS determination to the tax court. Now go to February 28th, 2007, a distribution of $640,000 is made. So now the executor has been put on notice from the IRS that the estate owes over $1 million in taxes and about $450,000 in penalty. He appeals the IRS determination to the tax court. And then what would that be? About 6 months later, he distributes another $640,000 as part of the original $1,045,000. So I guess for some reason, there's a holdback. Something wasn't distributed over all that time, right? Because now we're at almost 4 years. And he distributes $640,000. And now this is part of that total $1,045,000 in total distributions. In March 2010, the tax court reduces the estate tax liability $536,151 and find no penalties are due. So they go to court. They find that while there's still tax due, they reduce it significantly and find that there's no penalties. The IRS assesses in July of that same year, 2010, the IRS assesses the unpaid estate tax against the estate. In April, the IRS, April 2013 now. So again, July, this is why you've got to keep all your records, be very, very careful. So we go from Quang Lee dies in 2001. There's a determination in March 2010. So nearly 10 years, September 2001 to March 2010. In July 2010, the IRS assesses the unpaid taxes, the unpaid estate tax against the estate. Now, almost 3 years later, the IRS notifies the estate that it'll be seeking a tax lien to recover the unpaid estate tax. 3 years goes by, I'm sure there's correspondence, but then they get notice that a lien is going to be filed. In December 2016, the estate responds to this notice by informing the IRS that the estate's only asset is a checking account with a balance of $182,941 and offers that amount as a compromise on the estate tax. In 2018, a year and a half later, an IRS settlement officer rejects the compromise offer, determining that the IRS could collect against Mr. Freeze personally. So remember, he's the executor. He has nothing to do with the estate other than the fact that he's the executor. They determined that for this $536,000. Now the estate says we only have $182,000, and the IRS settlement officer comes back and says, yeah, but you could pay it. So if you have the money, then you could pay it as executor. Mr. Freeze personally, so they could collect against Mr. Freeze personally for the amounts he distributed from the estate between July 23rd, 2003 and February 27th. The IRS could also potentially collect from the beneficiaries who received the distribution. The settlement officer agrees with the IRS's decision to seek a tax lien. The estate appeals the settlement officer's determination to the tax court, arguing that Mr. Freeze is not personally liable for the unpaid taxes. He's just the executor. The court's decision, the tax court ruled that the settlement officer acted properly in rejecting the compromise offer because the IRS had the right to collect the unpaid estate tax against Mr. Freeze personally. Therefore, the court approved the IRS tax lien. Under the tax code, the executor of an estate must pay the estate tax. Furthermore, the executor may be held personally liable if he fails to pay. May be personally liable if he pays a debt of the estate before satisfying all claims owed to the U.S. government, including estate tax. An executor is personally liable for the unpaid claims if the executor makes a distribution of assets from the estate when either the estate was insolvent, or the distribution rendered the estate insolvent and the executor had knowledge or notice of the government's claim. So they're saying, since you knew that this tax was due, right, you were notified properly, and then you made that distribution. The way I'm reading this, it wasn't about the initial part of that $1 million distribution that they had such an issue with. It was the $640,000 some dollars that he distributed after the fact. The tax court said there was no dispute that Mr. Freeze distributed estate assets that rendered the estate unable to satisfy its estate tax liability. Before the February 2007 distribution of $640,000, the estate had sufficient assets to pay the $536,151 in tax owed. But afterwards, it only had about $183,000. So they're saying you have plenty of money to pay this before you did the distribution and you knew about it. The estate argued that Mr. Freeze did not have proper notice of the estate tax liability when he made the February 2007 distribution. However, the court noted that Mr. Freeze received the IRA notice in April 2006, 10 months before the distribution, and that he must have been aware of the unpaid excise taxes before he did the distribution because he appealed that deficiency. So this attorney and judge said, but I didn't know. And they said, well, of course you knew. We sent you the notice, and not only did you receive the notice, you filed a dispute of that notice. So then he said, Mr. Freeze said, the attorney and judge, he was not personally liable because he had relied on the advice from the estate's tax advisor. The court said this. I'm going to read you verbatim what they said. Mr. Freeze, a licensed attorney and judge, made the February 2007 distribution with direct knowledge that respondent had determined, that's the federal government respondent, had determined an estate tax deficiency against the estate. The government mailed him the notice of deficiency in April 2006, and that an action concerning that deficiency claim was pending before this court. Under these circumstances, Mr. Freeze made the February 2007 distribution at his own peril, and any advice he may have received in this regard cannot absolve him from liability. Thus, Mr. Freeze may be held personally liable for the estate's unpaid estate tax that remains due following the February 2007 distribution. That's in quotes from the court. They basically said you should have known better. You're an attorney and a judge, but I would argue that they would hold an individual to the same level of scrutiny. The issue with this was he made that distribution after he was notified, but he says first he says I didn't know, and then he says, well, wait a minute, I got advice to do this. Now, I talked last week about sometimes you get bad advice. Remember, I gave those two examples of the CPA who made mistakes, over converted. No such thing as over converting. Not today. Now you could have a tax payment you're not comfortable with, and you could call that over converting, but there's no such rule under the IRS rules that says there's a limit on how much you can convert. This CPA thought different. Then we had another CPA who thought, well, I can't make a contribution because my income is too high due to Roth conversions, and we know that's not the case. So people make mistakes, and you have to check these mistakes. You have to check your advisors. Now, I know that may be difficult at times, but if something doesn't seem right, you should always get a second opinion. The estate also argued that the IRS could not collect against Mr. Freeze because there was a 6-year statute of limitations. They tried another thing. Well, wait a minute. It's been too long. There's a 6-year statute of limitations. However, the tax court concluded that this was a misreading of the tax code. This poor guy just hit every cylinder wrong. Under subsection 6502A1 of the tax code, the limitations period for collecting estate tax against an executor is 10 years, starting on the date of the IRS assesses the tax against the estate. In this case, the 10-year period began running in July 2010, not in 2001 when this poor fellow passed, but in 2010. Am I right? 2001, yeah. But in 2010. So that's when the clock starts running. let's see. In this case, the 10-year period began in July 2010. The 10-year period was still open in 2018 when the IRS settlement officer rejected the estate's compromise offer. So this case is a good reminder, Ed writes, that an executor or other estate fiduciary is personally liable for unpaid taxes. In most cases, executors are family members who are unaware of their personal liability. Now, this is what I'm talking about. This is an area that is unfortunately just not touched. Attorneys don't pull people in, don't educate them enough. I have a booklet I give people who are fiduciaries. And while sometimes it applies directly, sometimes it applies indirectly, it's a great process to follow. So whenever you're responsible for someone else's money, whether you're a power of attorney, trustee, executor, I would say reach out to, I don't know anybody else. I've heard of one other fellow on the Eastern Seaboard who does this, the East Coast of the country, who does this kind of work. But it's very uncommon, and more people should be educated about their responsibilities, have a process for managing those fiduciary responsibilities, and do what they can to keep themselves out of trouble. So I don't know where this guy practices law or is a judge, but boy, I wouldn't want to be there. So what about IRAs? How does this apply to IRAs? Although this case didn't involve IRAs, keep in mind that both traditional and Roth IRAs are included as part of the owner's estate for federal estate tax purposes. This is another common misconception. Well, we know Roth IRAs, Roth 401ks are tax-free, right? So we're talking about income tax. So they come out tax-free. You want to make distributions tax-free for yourself as long as you meet the 5-year rule, that's fine. You pass them to your heirs tax-free, but are they calculated in your total estate? Well, of course they are. So, however, IRA funds that are payable to named beneficiaries are not subject to probate. Now, even though they pass directly to somebody, they're still calculated in the total estate. And the IRA beneficiary, not the executor, becomes personally responsible for any unpaid estate taxes attributable to those funds. So if you're an executor and you have a named beneficiary, well, then that beneficiary is now responsible for any estate tax that's triggered there. In essence, the beneficiary is treated as a statutory executor with respect to the IRA funds. However, the actual executor may have an obligation to take steps to ensure that the beneficiary pays the applicable state tax. I don't know what those steps would be. This is where an attorney would want to come in, probably a proper notice, some kind of either certified mail or service or something like that. Relieving the executor of personal liability is yet another reason to make sure that clients name an individual beneficiary on the beneficiary designation form. If an individual is not named, the estate would likely become the default beneficiary and the IRA would become a probate asset. This would cause the executor to become personally responsible for estate taxes on the entire estate, including the portion attributable to the IRA funds. Unfortunately, this happens, and I've talked about it before. People just name, per my last will or my estate, and that almost never makes sense, in my opinion. Here's another case from 2020. Estate executors are personally liable for unpaid estate tax, and this is the Kelly case, District Court of New Jersey, October 22nd, 2020. U.S. versus Estate of Kelly, and again, October 22nd, 2020. Executors and other estate fiduciaries are personal liable for unpaid estate taxes of the estate. In this case, the court found an individual responsibility for the remaining estate taxes because, as executor, he distributed the entire estate to himself without paying those taxes. After this same individual died, his daughter, who was the executor of his estate, was personally liable for the unpaid estate taxes of his estate because she paid that estate to herself before satisfying the associated estate tax. So this one passed down to the next generation, and boy, that's a shame. And it could have been easily avoided. All right. So that's a lot, I know. That's why I only wanted to touch on a few topics in the investment section today. Any questions about anything I just spoke about? Let's see. I don't see any questions. Okay. So that's it for our Tuesday webinar today. We went over the market updates, analyst report, slot mailbag, the slot report, and what I thought was this great Lee case. I love this section during our training. The case law updates and IRA updates. It's a lot of fun. So I look forward to seeing you all next week. And reach out if you have any questions. If you need to schedule time, the calendar will pop up when you're done. Thanks, everybody. Have a great day.
Hello again. I hope you enjoyed the video and perhaps you learned something new that can help you. If you want to schedule time for me for a no cost, no obligation consultation, you can use the link in the description and schedule a time that works best for you. If my schedule is full and you can't find anything, don't worry. Send us an email and we'll find a time that works for you. I look forward to speaking with you soon. Thank you. Have a great day.